3 great companies at 52-week lows. First one, Google. So guys, remember, our goal is to find great companies selling for reasonable prices. If you look at Google here, it's actually bounced off of it, but recently it hit as low as $2,100. It's actually below that on an intraday basis. So let's go right through our software. If you have our software at home, please pull it up. Go along with us. It really makes you a lot more comfortable with the software and loving it. So let's go to the 8 pillars. Look at the Goog. They have 6 check marks and 2 X's. What are those X's? Valuation. Does that mean we avoid it? No. If the company is growing fast and can justify it, you absolutely do it. So it's fast growth and its horizon. Now, everybody here knows I don't take analyst expectations for much, but it's still nice to look at what they're doing and to determine, hey, what are their projections for the future? So first, let's look at revenue growth. Google analysts expect about $300 billion in revenue this year, and over the next 8 or 9 years, getting it to $806 billion. What's that average? Well, you can look here at the year-over-year growth. It's low double digits, 11, 12%. That's pretty solid, okay? Earnings per share. Not as much analyst expectations, but they're expected to do $112 this year, and that'll go to $238 in 2027. Growth here, mid-teens, more or less. Great, so let's put it in our stock analyzer tool. Now, what is a stock analyzer tool? This is what we created because every investment's the present value of future cash flow. So let's go look at making our assumptions about the future and what that tells us and what we should pay for the stock today. So I'm going to factor in the analyst expectations of the low double digits for revenue growth. That's our first metric here, and I'm doing a 10-year analysis. So I'm going to go conservative. I'm going to go 6, 10, 6, 10, and 13. Now you might sit there and say, Paul, 6 is too low. I know. Remember, the future is hard to determine, and our goal as value investors is to make conservative estimates today that then allow us to buy stocks at prices where we don't need them to hit a home run in order for us to make our money. 13%, that's a pretty big stretch, but anything can happen. I would have never thought Google would have gotten 19.4% over the last 10 years, but you cannot expect that to continue forever. Okay, profit margin. Now here, I'm ignoring last year because it was a big jump last year. I'm going to focus on these 2 very consistent numbers, the 5 and 10-year numbers. I'm going to go a little bit more conservative, 21, 22.5, and 24. Free cash flow, I'm going to do the exact same thing. PE. Now this is where I'm going to get hazed. Paul, 13 PE, that's too low. I know. That's on purpose. Again, the Warren Buffett way is to buy great companies at good prices, right? But here, I have to assume, let me go really, really low. Now, do I ever go off this number? It's rare, but let me go really low. Remember, Microsoft was the can't miss stock of 2000. At one point in 2011 and 12, it was selling for 9 times profit. And look at it now. So it'll happen, potentially. And finally, guys, I always do 12.5% return for my investments because I want to have a reason to buy an individual stock and get some sort of extra return with a margin of safety versus an ETF. Hit the analyze button. All right. Well, if you believe my high expectations, it's a buy all day. Look at my low expectations. My unreasonably low expectations were $1,200. And look, right here, $1,900 is my middle range. It's probably somewhere, my guess, in these 2 areas. So you have to decide for yourself. Do you want or not? A lot of people disagree with me and say, Paul, I'm buying Google all day today. Great. There are a lot of hedge funds out there. Great. More power to you. Next company, Lululemon. So let's go to our 8 pillars. Type in Lulu. Again, follow along with the software. It's currently $295. It has bounced off its low, but it hit a low of $254, but a high of $485, guys. And I guarantee you, back here at $485, you'd be like, no way, it's going to follow too. Okay, and here's what happens. So let's go to the 8 pillars. Guys, just like Google, all the check marks here are high return on invested capital, revenue growth, net income growth, shares outstanding are down, low debt. Look at this low debt. They only have 1.4 times our last 5 years free cash flow and debt and cash flow growth. Boom. Financial valuation metrics. So let's look at what the analysts think. First, in terms of revenue, Lulu's revenue expected to be 7.58 for the calendar year, and it'll get to analyst estimates of 17.5, which ends up being high single digits, low double digits, mostly high single digit growth for the next 10 years. Guys, it's a big company, very popular. It's probably not going to grow as much as it did in the last 10 years. Let's look at earnings per share. Now remember, guys, it's easier to grow EPS because you can buy back shares, and with high margins, as the more and more you sell, the more and more it drives up earnings because you already have your fixed costs taken care of. So here, and look at this, $9.35 to $38 expected in January of 2032. That's 4 times more growth in terms of their profit, even though revenue wasn't going to come close to that. And look at these year-over-year growth numbers. Now remember, these are estimates. And the further and further you grow out, the harder and harder it is to be accurate. That's just the reality of it. Go look at what analysts expected Amazon to make back in 2005 for the next 10 years. They didn't hit it. But Amazon's killed it since then, right? So that's something to keep in mind. So let's go to our stock analyzer tool. High single digits revenue growth. And if you look at the last 10 years, they did 18.4. That will slow. Obviously, it has to slow because the bigger, not it has to slow, but it's more likely to slow because the bigger and bigger the company is, the harder it is to grow. So again, I'm going to do 5, 8, and 11%. I'm going to do 14, 14.5, and 15. I'm going to do the same thing here because over long periods of time, free cash flow and earnings should be pretty similar. And again, 13, 15, 17, 13, 15, 17, and 12.5% return on my money. Hit the analyze button. The company's currently at 295. Oh boy, a low of 90, a high of 175. In the middle is 120 to 130. Now guys, for this, I could add I added notify me, pick my stock price, notify me when it hits there, and do that in the software. Guys, at the end of the day, 40 times earnings and free cash flow is a hard number to get. If they had massive growth potential, let's put it in here. Let's say 20% revenue growth potential. Does it even justify today's price? It does. They need 20% growth potential to justify today's price. It's probably not very likely considering they grew at less than that over the last 10 years. That's just my take on Lulu. Next company, Tractor Supply, TSCO. Again, pulling up the software, TSCO, Tractor Supply Company, 52-week high of 240. It had a low of 167, which has bounced off quite considerably to 188. Let's go to the 8 pillars here. Okay, now this one has a few more X's. It's the valuation metrics for sure, but their cash flow is down over the last 5 years and their debt's a little bit higher than they want to be. So, big thing to do here is understand these two numbers. Why is cash flow down over the last 5 years? Why do they have higher levels of debt? It could very well be okay their debt level's high. I don't know, but I look at gross profit here and bottom line profit and think, you know, it's not astronomically high. I want to be more conservative on my debt levels. Okay, so where do they stand here? Let's go to the stock analyzer tool. All right, guys. So this is a company that opens locations. They open more locations. So you want to go look at their comparable sales growth. If their comparable sales are still growing per store, that's a good sign. You want to be very apprehensive if their stores that are comparable sales, which is stores open more than 12 or 18 months, are decreasing. That's a problem. You want to make sure stores are able to stand on their own and grow on their own. So let's do some assumptions here. So here are the analyst expectations for the company in terms of revenue growth for the next 10 years, so years. They're going to do 13.84 estimated to 23 billion. Okay. Look at these numbers right here. This is mid-single digits. Mid-single digits. So it's not a big growing number. Last 10 years, it did 11.4. It's going to be dropping in half. How about EPS growth over the last 10 years? Let's expand this a little bit in the next 10 years. So here, this is 6 or 7 years of growth. You're looking at mid-double digits, mid-teens. Okay, a lot different. Like I said, it's easier to grow EPS than it is revenue, especially if you're buying back shares. So back to the stock analyzer tool to put our own assumptions in. I'm going to put in 3, 5, and 7. Profit margin. Guys, it's pretty consistent here. I'm going to stay at 6.75, 7, and 7.25. Now look at this. Their free cash flow was a lot lower last year than their profit margin. So there's probably a reason for that. So I'm going to sit there and bump these numbers. I'm actually going to keep this at 6.5, 6.75. I'm just going to go a little bit lower. Now, guys, the big thing on these assumptions are it's all personal based. It's one of the most common questions we get in our community over here. This community was created, the software's created because people wanted to analyze their own companies. I strongly encourage you that in order to get these estimates, you do a little bit of your own research, but use this community over 6,000 people in there to talk about Tractor Supply or any other company you're looking at. You can literally go in the search, type in TSCO or Tractor Supply, and it'll take you right to the conversations people are having about it, and you can engage in them. Because is it easier to do research by yourself or with 6,000 other people? It is a no-brainer. Do it with other people. Get their input. Guess what? I have conversations in our community all the time about individual companies, and people disagree with me all the time. And guess what? I am wrong a lot. So is everybody else. That is the art of investing. Everything is about the assumptions. But you can get a feel for what other people are thinking, and they'll sit there and say, well, I factored in 8% because what Paul is missing is this. Just today, I got a comment from somebody, Paul, I think you're missing a big revenue growth component of Intel. I was like, great. It makes my thesis better. That's the best part about it. It's not about just being right. It's about having engaging conversations about how we think about things. If somebody told you in the chat, Paul, I think Tractor Supply is going to do 40% revenue growth for the next 10 years, I'd be like, why? But they might have a reason for it. More power to them. So guys, join this community. It is a no-brainer. It's less than a cup of coffee a day. Just go to everythingmoney.com or Patreon if you're international and just sign up. Less than $1 per day. It's a no-brainer. It's super easy. And have everybody help you figure out these numbers because it's so easy to do and it's way better than just doing it by yourself. So PE, 13, 15, 17. Price of free cash flow, same thing. And like usual, my desired return of 12.5%. I hit the analyze button. All right, so it's getting closer. The low is about 90, so it's got to fall in half. The high is 145, 150, and the middle is 115 to 110. So I'm going to sit here and say, hey, listen, when it gets to the low point of this one, of the highest number, notify me. Does that mean I'm going to go buy it? For me personally, I set notifications so I can go do more research. I don't want to waste my time doing more research. Neither should you. Join the community. Thanks very much, guys.